Okay, we're going to kind of wrap up revenue recognition with this final lecture. I'm not going to go into too much detail on the first part of it. We're going to spend a little more time on a long-term contract just to give you an idea of how all these concepts can come together. First of all, we're going to talk about contract assets and liabilities. Just sort of before we get into each one, I think it's important we remind ourselves of the conceptual framework. And basically the idea here is that revenues and expenses are derived from changes in assets and liabilities. This is something we've talked about a lot and something that should be ingrained in you as an intermediate accounting student. So revenues and expenses are derived from changes in assets and liabilities. This is really important. And so under US GAAP, the way that we treat contract assets and liabilities does have important implications for revenue recognition. So these account names, contract asset and contract liability, they are not in any way prescribed as being the names that are required by US GAAP, but they are commonly used, so I'm going to use them. And it's also what's used in the textbook that I usually teach from. Okay, so the contract asset really depends on whether there's a conditional or an unconditional right. So if a firm has an unconditional right to consideration, and usually it's going to be cash, but it could be something else, then the seller would record a receivable. So an unconditional right to consideration means that the firm has a receivable. But if the firm has a conditional right, basically meaning that some performance obligations have been met, but not all of them, then the firm records the value of the consideration as a contract asset. So again, unconditional rights result in receivables. Conditional rights result in contract assets. And then a contract liability is just another name for unearned revenue. Seller receives payment and must provide a contractually obligated service or good at a future date. You've probably seen this when you covered current liabilities, so I'm not going to talk too much about it here. All right, contract modifications. Whenever there's a change to a contract, it can be treated as a new contract or it can be treated as a modification of an existing contract. So what would be required for the firms to treat any change as a new contract? Number one, the promised good or service must be distinct from the prior contract. And number two, the company must have a right to standalone consideration for the promised good or service that's part of the change. So again, the good or service must be distinct and there must be standalone consideration. If both those criteria are met, then the firm can record a new contract as opposed to recording a modification of an existing contract. So a new contract is treated as a separate performance obligation, whereas a modification is treated as a prospective modification. It's important that whether you have a new contract or a modification of an existing contract, that the revenue that's going to be recognized is the same in total, but the timing could be different depending on which situation you find yourself in. And so let's talk about an example. So 49er Company signs a one-year contract to deliver 1,000 units at $10 per unit on January 1st, 2018. By July 1st, 49er had delivered 800 units, but the client would like an additional 1,000 units. However, the client would like a discount since the order is larger. So a 49er can distinguish these additional units from the previous order, and if 49er offers the client standalone pricing, then the change would be a separate performance obligation and would be treated as a new contract. So as an example, if 49er agrees to a $9 per unit price for any units that are sold over 1,000, so if they offer that, now we have that distinct goods or distinct units and we have standalone pricing. So this could be a new contract, and so these additional 1,000 units would be a separate performance obligation. So they would recognize first the $10 per unit times the remaining 200 units, or that $2,000, that would be recognized first. Once that's complete, then they would recognize the additional 1,000 units at $9 per unit for a total of $9,000. So they'd have $11,000 of total revenue, but you'd recognize basically the $10 per units first, and then the $9 per units second. So same situation, but let's say that 49er does not distinguish or does not offer standalone pricing. Then it would have to be a contract modification. So now they agree, instead of offering the $9 per any units above 1,000, let's just say they say, well, we'll provide the remaining 1,200 units for $11,000. So in this case, we don't distinguish which units are which, and we don't have standalone pricing. So this is going to be a contract modification. So 49er would recognize $9.17 per unit as each unit is provided. All right, now we have costs to fulfill a contract. This is kind of a review of what you probably had in cost accounting, but we'll go over it very quickly. First of all, a contract cost, it can be capitalized or it can be expensed as incurred. US GAAP favors expensing costs as they are incurred. However, you can capitalize a cost if that cost is direct, incremental, and recoverable. So it has to be all three criteria. Again, a lot of these concepts would have been covered in your cost accounting course, so I'm not going to spend too much time on it here. Long-term contracts. All right, so we're going to spend a little more time here. So firms must typically wait to recognize revenue until a performance obligation is fully met. This is what's known as a completed contract method. However, some long-term contracts might include performance obligations that take a lot of time to complete. And so some examples might be like a major construction project, whether that be like a building or an interchange at a highway or something like that. A lot of times long-term development contracts are similar. So if the US government wants to develop a new aircraft or a tank or something like that, it could take 5 to 10 or 15 years to develop that. And so some of those performance obligations could take more than a year, 2 years, 3 years, something like that. And so it's important that we distinguish. Sometimes we have these long-term contracts, and under a completed contract method, they could not recognize any revenue until a performance obligation was entirely complete, and that could be potentially be a long time. And so under certain circumstances, US GAAP allows firms to recognize revenue over time before a performance obligation is complete. And this method is known as the percentage of completion method. In order to recognize revenue over time, the one of three criteria must be met. First, if the customer simultaneously receives and consumes the benefit of the entity's performance as the entity performs. There's a lot of different ones, but basically let's say that I'm creating like a network or an infrastructure for a city. And as we the contract might call for everything to be done, but as I complete certain sections, let's say the city can use and consume that benefit as I'm completing each section. So that would be a criteria that would allow us to recognize revenue as each section is complete, even though the entire city might not be done. Number two, the company's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. A common example of this could be a building remodel. So let's say that you have a large building and a contractor comes in and they're gonna remodel everything. Well, the client firm, the landlord or the person who owns the building, they control the asset. They control the building as it's being created or enhanced. And so that would allow the contractor to recognize revenue over time. And then three, this one's probably, it's pretty common in development contracts and things like that, and in long-term construction contracts. And so a lot of times, this third criteria at a minimum is what would trigger the ability to recognize revenue over time. And so let's talk about it real quick. So the company's performance does not create an asset with an alternative use. In other words, I, as the contractor or as the seller essentially, I cannot allow the asset to be used by another customer. So that's kind of a big one. So, imagine I'm working on a building. I can't, that building's not going to be used by another customer. And so that's pretty easy. But there's two other criteria that must also be met. One, another company would not need to substantially re-perform the work that I've already completed if that company were to fulfill the remaining obligation to the customer. So in other words, someone should be able to pick up where you're leaving off. If someone's able to pick up where you're leaving off, then you're sort of one step closer to being able to recognize revenue over time. And then secondly, again, both must be met. The company has a right to payment for its performance completed to date, and it expects to fulfill the contract as promised. So in other words, there must be this ability to bill the customer and to get paid for what work I've completed. Most government contracts are this way. They sort of should be able to re-compete out any additional work that's remaining. And then also, they should have some sort of mechanism to get paid for the work they've done. Early in my career, I worked on government contracts, and this was part of what we had to do is we were developing new technology, but at each phase we would re-compete it out. And so the contractor, whoever sort of performed, let's say, the initial research, somebody would have to be able to pick up where they left off, and they got paid for the research they did, even if we didn't end up completing the remainder of the contract with that firm. And so they could recognize revenue over time rather than having to wait to the end. And some of these development contracts are 5, 10 years. All right, let's do an example. So a construction company has a 3-year contract to build a new dorm. And we're going to look at basically what would happen during 2018. So there's an estimate where they're going to get paid $10 million. The construction company believes they're going to incur costs of $8.5 million. And then they did some work in 2018. So we have to figure out how we would handle each of these items, whether it be the $3.5 million in cost that they incurred, the $3.3 million that had been billed, and the $2.9 million that had been paid, and then how do we handle recognizing revenue? All right, first thing is let's just provide the journal entries for the work that had been completed, billed, and collected during 2018. And so basically, as work's being completed, or as those costs for the work are being incurred, the construction company, 49er Construction, would create this account called construction in process, and that is a contract asset. And the credit would be, I'm using inventory, I'm incurring payables, I'm paying cash to suppliers, all those things. Those are the credits. And then there's this debit, this construction in process account, which is an inventory account where we're sort of holding all these costs as a contract asset. And then basically, as then we sort of get to the point where we can bill the customer, now we're going to create accounts receivable, and we have this other new account called billings on construction in process. And this is basically a contra account to that construction in process where it kind of offsets those costs that we've incurred. And then finally, and hopefully this is an easy one, as those receivables are paid, they go off our books and we receive cash. But again, I want to highlight that construction in process is a contract asset, and billings on construction in process is a contra account to the construction in process account. So because sort of those two together give you a net contract asset. All right, so now there's an adjusting entry that we need to do at the end of the year in order to account for the percentage of completion method. And then again, this is the idea that we're creating financial statements. We want to recognize revenue based on a partial completion of the project using the percentage of completion method. And so the first thing we have to calculate is what percent are we complete? Well, we had $3.5 million of costs already, and we anticipate another $5.2 million. We know the initial estimate was 8.5, but now we can see we have a new estimate of 8.7. We use that new estimate as the basis to figure out what percent complete we have. And so we can see that we've completed, according to our costs, 40.23% of the contract. We apply that percent to the total revenue that we're going to recognize over the life of this contract. And so that means revenue to date for 2018 is 40.23% of 10 million, or $4.023 million. And so from that, we have our journal entry. Now, I'm going to start with the revenue and expense, and then work back to the construction and process. And so you can see revenue to date is the revenue from long-term contracts amount. That's the 4.023 million. And then it's important that we record the construction expenses that we've incurred to date, which is that $3.5 million. And so those are calculated amounts. Both of those accounts are temporary accounts that will get closed. But if you notice, when they get closed, we would create $0.523 million in retained earnings. And so we sort of work backwards and then say, well, if there's an increased retained earnings, there must be a change in our assets or a decrease in our liabilities. And so what we do is we add that amount to our construction and process. And so the idea is that our efforts have resulted in a profit. And that profit isn't yet fully recognized, but we're going to recognize a portion of it. And so that profit creates an asset. There's this expectation that we're going to have a future economic benefit. So there's this asset that's been created because we're going to be compensated for the costs that we've incurred. And so that asset then kind of results in this, sort of increase to retain earnings through the difference in the revenue from the long-term contracts and the construction expenses. This journal entry typically is the one that's most difficult to understand, but if you just want to think about it, our efforts, our costs are creating a profit. That profit is an asset. It's an expectation of future economic benefits, and this is how we're going to record it. So what's going to be reported on the financial statements? First of all, on the income statement, you're going to have the revenues from the long-term contracts, you're going to have the construction expenses, and that's going to leave us with a gross profit. And that gross profit is that future economic benefit, that asset that we believe we're going to receive. On the balance sheet, of course, we have the remaining accounts receivable. And then under the inventory account, we would see construction in process, which is the balance. So it's the $3.5 million in costs that we had recorded throughout the year, plus the amount from the adjusting entry. And then we'd subtract the billings that we've already recorded, and we can see then we have costs and recognized profit in excess of billings for a net amount of $0.723 million. And so if you kind of go back to our income statement, that tells us that the net amount is a function of two things. It's a function of the profits that we've recognized, and it's the cost that we've incurred in excess of our billings. And so it's those two things together that give us this asset, this probable future economic benefit that we expect to receive in the future.